What's going on? Welcome back. Ryan here. In this video, we're talking about the short straddle and the short strangle. Okay, now these are option strategies that are unlimited risk. Okay, so again, we'll just look at Apple here as an example, and we'll take a look here at the short straddle first. Okay, so we'll just come into this 8 days out right here, and if we think that Apple is not going to move much, we could do a short straddle where we sell this at the money 175 strike put, and we also sell that 175 strike call, and together, when we sell those together, it's going to give us a graph that looks like this, right? It's like this pyramid tip where you have limited loss to the downside, right? Which you incur that loss if the asset drops below your strike price, and then you're assigned long 100 shares, and as the asset drops, you're long the 100 shares, so you're losing money. Again, on the upside, if Apple rallies above your strike price, you would be, you sold that call, right? So if it's above your call, you would need to sell short, right, to the obligation you've made. But again, you have unlimited risk to the upside, right? Because there's no cap on how high Apple can go, or any asset can go for that matter. But just be aware that these can be very highly profitable strategies over time, right? When you have margin and maybe the underlying asset or security is just not moving much. Remember, implied volatility is either going to underestimate or overestimate the move versus the historical volatility. And it's important to be aware of these things because, again, when volatility is high, when the relative IV rank of the underlying security is high relative to its historical performance, right? We want to be on the right side of volatility, right? So we want to sell the more expensive options. We want to buy the less expensive options. So again, the short straddle is where we come in again to an underlying security. And it doesn't have to be at the money, right? You could easily sell one of these out of the money where maybe we think that Apple is going to go down a little bit to the 170 level. So this 170, we could sell this one and sell this one. And again, we would have the same type of graph, but now the underlying security is starting higher up here. So for this to be profitable, right? I mean, it could stay here and be profitable, but if it moves down towards that 170 strike, right, as time ticks away, we're going to make money from theta decay, right? The option losing value and the fact that we sold it. Okay? Now, the other variation of this that's similar would be the short strangle, right? And the short strangle is a little bit different because we're targeting different strikes. So if we look at Apple, if we're looking at Apple, $176.28, and we wanted to come in and sell a short strangle, well, we could think about it like this, right? For this December 31st, 21 option expiration here, 8 days away, it's giving us an implied volatility of 26.34%, and it's basically saying Apple can possibly move plus or minus $5.66, right? So $5.66, right? So 176.28 minus $5.66 gives us the 170. Okay, so there's the 170 and 176.28 plus $5.66 gives us 181, right? So if we were going to sell a short strangle outside of the implied volatility move of Apple here, we could sell this 170 put and we could sell this 182.5 call, and we would take in a credit of $1.23, which on one contract is $123, so not that much. Our buying power for effect on this is almost $3,000. So again, 123 divided by 2907 times 100%. This gives us a cash on cash return of almost 4.23% over 8 days if this expires worthless and Apple trades in between these strikes, right? So what does this look like though, right? So again, and what I'm going to do here for comparison is I will come back in here and we'll just do the straddle, right? So here we have the straddle, right? This is what we first talked about, where we're selling a call and a put with the same strike, right? Anticipating that there's not going to be much movement, that it's going to trade sideways, and through the passage of time, we're going to keep that premium. Again, limited risk to the downside because it can only go to 0, but unlimited risk to the upside because there's no cap on how high it can go, right? Now, when we compare this straddle to the strangle, we can see that the straddle and the strangle are different in the sense that the straddle is going to produce more income, right? There's a higher peak. You could make more money on this, right? You're taking in a larger credit. But you also have your break-even point on the wings is going to be closer to the money, right? So on this one, the break-even is like 180 and 169, as opposed to the straddle, right? There's not, right? It doesn't have as much premium, right? Because we're selling farther away from the money. But again, on this one, the break even is much wider, right? And today is Thursday the 23rd, and an important feature I haven't talked about yet, we'll talk about it right now, is when we're looking inside of Thinkorswim on this Analyze tab, this shaded area here, so here is the actual price, right? It's this middle dashed line. And this shaded area is showing us the potential implied move that this could make over this expiration of 8 days, right? So as we step through the dates, right, towards the 31st, this gets smaller and smaller and smaller because the chances that Apple is going to make a move outside of that standard deviation range decreases, right? So again, when we get to the last day, then it expires and it's all done, right? So again, remember when I put this trade on and I was looking at this implied volatility, right? $5.66 move potentially up or down. When I was making this trade, right, I specifically chose strike prices inside of this expiration with this implied volatility that was outside or very close to that range, which would then give me a higher probability of winning this trade. Okay, really important to think about these concepts, right? Where the option prices are pricing in a certain like a move, right? It's pricing in that implied volatility, what this could potentially do, and then us as option traders, our job is to make high quality decisions and put the math in our favor. And in this given example, when we selected the strikes on this strangle, we chose strike prices that were close to or outside of that implied volatility range. Now, again, the straddle is the short call, the short put at the same strike, and the strangle would be the call in the put at different strikes, you know, the put below the market, the call above the market. Okay. Another interesting thing to look at is this probability analysis page. Right, this is giving us kind of that bell curve graph of like where the price is right now. So here, this line in the middle, 176.28, is the price that it's at. And then we have, here's our volatility rating, and we can see that above and below this market, this is a range where it has a probability of falling. So again, in here are the different option contract expirations, right? This is an expiration, this is an expiration, and we can see that this probability analysis chart is pricing in that volatility of the range that this security is going to fall into the majority of the time. This is very important information when we're trying to make money with options and we're putting on trades. Really important to always be aware of volatility and what type of move the volatility is pricing. Now, there are scenarios, again, where the volatility is going to either underestimate or overestimate that move. And this usually happens when markets go from trading sideways to then gaining momentum and trending. So really important to understand that when the market changes from trading sideways to then going into a momentum move up or down, that the option prices and the market makers will oftentimes underestimate that scenario. Okay? But again, in this video, we talked about, right, the strangle, the short strangle, and the short straddle. Again, the short straddle being selling the call and the put at the same strike, and the short strangle selling the put beneath the market, selling the call above the market. So again, if you have any questions, feel free to reach out. And I will see you in the next video.